Hey there, future millionaires. Ever wonder how companies grow from tiny startups to household names? The answer is stocks. Think of stocks like little pieces of ownership in a company. When you buy stock, you're basically buying a slice of that company's future. Now, why should you care? Because investing in stocks is one of the most powerful ways to grow your wealth over time. It's like planting a money tree that could potentially bear fruit for years to come. But just like any garden, you need the right tools and knowledge to cultivate success. That's where this guide comes in. We're going to break down the basics of stock picking so you can start building your own financial empire. Ready to get in the game? Let's do this. Before you go on a stock buying spree, pump the brakes. Just like you wouldn't buy a car without kicking the tires, you shouldn't buy stocks without doing your research. Start by understanding the companies you're interested in. What do they do? Who are their competitors? What's their track record? The more you know, the better equipped you'll be to make smart investment decisions. Luckily, there are tons of resources available to help you out. Websites like Yahoo Finance and Google Finance offer a wealth of information on publicly traded companies. You can also check out financial news sites like CNBC and Bloomberg to stay up to date on market trends and company news. Remember, knowledge is power. So do your homework and invest with confidence. Now, let's talk numbers. The stock market is full of them and they can seem intimidating at first glance. But don't worry, we're going to break down some key metrics that will help you analyze stocks like a pro. One of the most important metrics is the price-to-earnings ratio, or PE ratio. This tells you how much investors are willing to pay for every dollar of a company's earnings. A high PE ratio could indicate that investors are expecting high growth in the future. Another key metric is earnings per share, or EPS. This measures a company's profitability on a per-share basis. The higher the EPS, the more profitable the company is considered to be. You should also pay attention to market trends. Is the overall market going up or down? Are there any specific sectors that are performing particularly well or poorly? Understanding market trends can help you identify potential investment opportunities. Section 4. Picking Winners, your step-by-step guide. Alright, ready to pick some stocks? Here's a step-by-step guide to get you started. Step 1. Define your goals. What are you hoping to achieve with your investments? Are you looking for long-term growth or short-term profits? Step 2. Determine your risk tolerance. How much risk are you comfortable taking on? Investing in individual stocks can be risky, so it's important to invest only what you can afford to lose. Step 3. Choose your investment style. Do you prefer to be a hands-on investor, or would you rather take a more passive approach? Step 4. Research and select stocks. Use the metrics and tips we discussed earlier to identify companies that align with your investment goals and risk tolerance. Step 5. Start small and diversify. Don't put all your eggs in one basket. Spread your investments across different companies and industries to minimize your risk. Step 6. Monitor your investments. Keep an eye on your portfolio and make adjustments as needed. Section 5. Don't put all your eggs in one basket. Diversification is key. Imagine putting all your money into one single stock. Sounds risky, right? That's where diversification comes in. It's like having a backup plan for your money. Diversification means spreading your investments across different asset classes, industries, and geographical locations. By diversifying, you're reducing the impact that any one investment can have on your overall portfolio. Think of it like this. If you only invest in tech stocks and the tech sector takes a hit, your entire portfolio could suffer. But if you have a mix of tech, healthcare, energy, and other sectors, you're better protected from market volatility. Diversification is your secret weapon for a smoother investment journey. Don't underestimate its power. Section 6. Risk friend or foe. Mastering the stock market roller coaster. Let's be real, the stock market can be a wild ride. There will be ups and downs, twists and turns, but remember, volatility is a part of the game. The key is to understand and manage risk. Before you invest in any stock, ask yourself, What are the potential risks? What could go wrong? It's also important to have a plan for what you'll do if the market takes a downturn. Will you hold on to your investments? Sell them? Remember, risk and reward go hand in hand in the stock market. By understanding and managing risk, you can make smarter investment decisions and ride out any market storms.